It was the ultimate macro trade, wasn't it, really?
Yeah, it was a brilliant macro trade. And if you think about it, the trading houses are like buying ETFs on Japan's economy. I mean, they are little micro structures of Japan's overall economy. So if you did the right trade, I think the thing to watch with Buffett would be when he decides to pay down that debt. When he decides to say, okay, that's it, we're going to he's got the cash to do it. So just take that and pay off the debt.
Yeah.
That would be because he believes the yen has probably bottomed. And he might even begin to sell the trading houses because they're the component of the Nikkei that has the most exposure to overseas earnings. That's what the first part of the lost decade looks like. If they don't take a draconian approach like they empowered Zhuronji to do in the late 90s, they will tinker and tinker the way Japan did, and they will end up taking 10 years, and you will have your lost decade.
I increasingly believe that to invest in today's markets, one needs a macroeconomic framework. Pure momentum or valuation approaches to investment are insufficient. I've been keen to talk with people who understand the macroeconomic and geopolitical landscape we operate in and have mental models of how to use these dynamics to identify opportunities of risk asymmetry. Two of my guests this year from the world of global thematic investing, David Dredge and Marvin Barth, both cite the influence of Mark Farrington as someone they refer to when seeking insight, particularly when it comes to developments in Asia. Mark Farrington writes about global thematic investing in his Watchtower series on Substack, the Global Watchtower, the Dollar Watchtower, and the BoJ Watchtower. Mark is as prolific as he is insightful. So it was a great pleasure when I got the chance to catch up with Mark for a fascinating conversation about his experiences and learnings from a long career following developments in Asia, from the rise of Japan in the 1970s and 80s to its lost decade, and then the rise of China. In particular, I was keen to ask Mark whether Japan can normalize its monetary policy without collapsing the global financial system, whether China will follow Japan into a lost decade of debt deflation, and how the poorly understood markets of Asia might impact our economies and our financial markets in a new world order with its reassertion of economic nationalism. Mark delivers a masterclass on hows and whys of global thematic investing. It is an episode that should have a long shelf life. It is one of those episodes that I learn more from each time that I have listened to it. But of course, none of what you're about to hear is any kind of advice, but hopefully for your information and entertainment. Please take personal financial advice before investing a penny of your money in these crazy markets. With that, please enjoy my conversation with global thematic investor Mark Farrington.
Brought to you by Progressive Equity.
So, Mark, thanks for joining. Can we just start by hearing a little bit about your background and your journey into becoming a global thematic investor?
I started my career in Tokyo in the 1980s, initially on the strategist side, a central bank specialist, and then eventually a more holistic Japan economic and political specialist. And then I transitioned to the money management side in the 90s, where Bankers Trust hired me to run some internal hedge funds for them, where it was a lot like proprietary trading. But then as the 90s moved on, I began to develop my own investment process. And it was the advent of the big cross-border capital flow phase of globalization, and valuation-based models and a lot of business cycle-based models were no longer very effective in predicting things. And I found the thematic organization of macroeconomic fundamentals the most consistent and the most useful in terms of identifying the kind of risk asset proxies that you end up buying and putting in your portfolio. So I eventually became a thematic investor and started developing investment process tools that would help me do that.
How would you define thematic investing? How does one go about looking for an investment theme to invest behind?
Well, this is a massive oversimplification, but I think that a lot of investment styles can be distilled into sort of three buckets: valuation-based or momentum-based, and then I put in the middle thematic. So a bottoms-up valuation type of investment style is perhaps more traditional and classic. Maybe Warren Buffett epitomizes that more than anyone else. And then the momentum end of the spectrum got a big push starting around the late 90s, early 2000s, when quant models came in and began to build factor-based models that had a reasonable success in predicting future movement. Thematic, I think, sits in the middle where you try to develop a big worldview. It's top-down global macro, I guess, initially, but then you eventually try to distill your global macro thesis into 3 or 4, maybe maximum 5 types of themes, which later now more often are called narratives. And then you try to understand how that theme rolls out and gets discounted in all the risk assets. And that helps you to decide what type of investments you're going to make that are going to benefit from that thesis. But the reason I like thematic is, a theme can run from anywhere from 6 months to 10 years. It gives you a lot of flexibility on time horizon.
So does that depend on your worldview, if you like? And how would you characterize your worldview and the things that have influenced your worldview and your approach to investing from, your education, the formative stages of your career?
My education almost coincidentally ended up being very useful. I don't think I had a very clear picture of what I wanted to do when I was studying, but I was always interested in, the frontier, what's happening out on the periphery. And in, the early 1980s, when I went to university, the big stories were Japan and China. Japan, from a manufacturing prowess, the great Japanese manufacturing miracle was being taught in American business schools, and we studied this success story. And then further out on the horizon, China under Deng Xiaoping had just opened its economy ever so slightly with these free economic zones. And so I studied also the China open door economic policy thesis and whether China would indeed rise one day and emulate Japan or not. So I studied those and then went off to Tokyo, more on a gap year to travel around Asia, to be honest, but then ended up getting hired in Tokyo, so I stayed. And I really didn't feel like I needed that Chinese aspect of my studies at all. And the Japanese miracle was already beginning to end. So in the end, the education didn't do much, but I would say now, 30, 40 years later, it started to become very useful because some of those long-term predictions have indeed come true. I became a believer in industrial policy by living and spending the first 10 years of my career in Japan. Japan was integrated into the G7, G5, was considered a good ally, doing everything right in terms of an emerging market, rising up the value chain and onboarding in the global institutions. And yet it was pursuing industrial policy all the way up until 1995. They used the term mercantilist back in those days, but not as negatively as they do now, because it's quite predatory phase of mercantilism. That's where I became convinced that industrial policy actually works. It helps a small, mid-sized nation to navigate the constant changes in the global economy. And that has influenced my thinking a lot today as I see the US and the great powers trying to do the same thing.
Given what you've said and your starting point back in the 80s and 90s, can you just give us a broad overview as of today, the state of world markets, through the sort of mental framework that you developed?
I would consider, the period of 90s up to maybe 2005 as this period of unfettered globalization where the collective worldview was that maximum integration, maximum cross-border capital flows, maximum push of innovation, regardless of how it was disrupting everyone's populations, was the goal.
It was the end of history, right?
Yeah, the end of history. But I also think, having interacted a lot with the policymakers of many countries during that period, they knew that it was disruptive. They could see that it was forcing a lot of change on the population. But it was justified that in the end, there was going to be this kind of rising tide that lifted all boats. What happened with the global financial crisis in 2008 was the rejection of that payoff. The idea that after 15 years of unfettered globalization, eventually the payday would come and nations would be wealthier and the trickle down to all of its citizens would take place. So 2008 sort of debunked all of that.
Do you think the period from the late 90s up until 2008 was the period where the West was borrowing on that future payoff and the debt was called in prematurely, or we'd exceeded our borrowing limits, clearly, and that was the wake-up call? Is that a way to think of it?
You can think of it in that terms. I also think that not every country obviously responded to 2008 in the same way. It was, in my opinion, slightly mistakenly interpreted as a US-centric event. I would say it was a developed market, financial market event. There was hubris across the OTC and derivatives markets in almost every asset class. The US property market was a small percentage of that. This whole house of cards and the derivatives market built on top of a small percentage of underlying assets is the real nature of the problem. And that proliferated from, say, 1995 to 2008 in a host of countries, Europe and Japan included. But what I mean by the payoff from globalization is that Main Street was waiting for its dividend. Wall Street was booming, the tech companies were booming, the global multinationals were booming, and Main Street was waiting for its payday. Whether that payday would have ever come or not, who knows? But 2008 interrupted the illusion that it was one day going to come, because suddenly the West just ran out of money. I mean, the bailouts were very expensive, and they implied a kind of government subsidy or care for the economy afterwards that wasn't going to leave much for trickle down and benefits to mainstream. And so you got the natural political reaction that you would expect from that, where mainstream understood they're going to have to fight and claw back what is theirs. It's not going to be gifted to them out of a windfall profits from the elites. So this is why I think the West reacted in that way. Outside of the West, in particular China took a totally different message from that. And it was a message that was building on from the Asian financial crisis, where most of the Asian countries, which everyone has to remember, China emulated its growth story completely on the sort of North Asian miracle of South Korea, Japan, and Taiwan. So the Asian financial crisis was a very important lesson for China as well. And that was about having a closed capital account, not allowing a lot of financial engineering and high leverage, keep the real sector and the manufacturing sector the dominant feature of your economy, not the banking sector. And so with the 2008 financial crisis, that validated that view. And then China began doubling down after that on real economy type of development and export capacity and buying and securing supply lines around the world. So for everyone taking a different message following the global financial crisis, that view that the rising tide of unfettered globalization was finished, and we now have a different form of globalization where it's still going on in the areas where it's tolerated, and it's becoming highly controlled and impacted by industrial policy in the areas where now vulnerabilities have been identified. So this is why I'm saying that thesis, that indoctrination into the value industrial policy that I understood from the 80s, the 90s, living in Japan during that period, has now become very valid and very helpful in terms of anticipating what's being done right now as we have this global trade war and this change in the way people want to control globalization.
So when you talk about industrial policy, is that the same as economic nationalism?
Well, the Trump version blends those two. So I think the world can be forgiven for interpreting that way. But the Japanese and the sort of Korean and Taiwanese version of industrial policy, through the 80s and the 90s that produced those economic miracles was more about understanding where's the niche that we can carve out in the global economy and sustain our population, basically. So every country is gifted certain, endowments, both population and resources, and geographically. And then you have to decide, how do you fit in the global economy and what niche can you carve out and defend? And, Japan moved steadily up the value chain and eventually dominated automobiles and electronics. And then Korea came in and replicated, and Taiwan identified immediately that the next phase would be semiconductor chips and investment in the components of electronics and began to focus there, et cetera. So industrial policy in those days were about building the platforms, ensuring the energy was provided and the financing was provided so that these corporates could succeed. So it was much more sector driven. It was nationalistic in a sense that there was a top-down exercise that took place first about where can we legitimately compete. For example, South Korea didn't say, well, we can take on Wall Street and we can become a global financial center. They didn't do that because they understood they didn't have the advantages. Tokyo actually did, during the 80s and 90s, take on London and New York. And they succeeded for a while, but they ran into a wall based on, labor market limitations.
I think in 1989, the 10 largest banks in the world by market capitalization,
they were all Japanese. Yeah.
9 of them were Japanese, yeah.
No, they're Japanese.
And the 10th was Credit Lyonnais, according to the artificial intelligence bot that I asked a few months ago. So I just think that's absolutely amazing. And it took me way back, being in the UK in the late 1980s. The market was all about, if the Conservatives get back in, there's going to be a tsunami of Japanese capital coming into London, because that was where all the money was.
Yeah. It's a good point you make about that, because the Japanese banks were winning that top 10 ranking, both on market cap valuation, but also because of yen's strength. But they were not the same sort of banks that we had in London and New York. They were not investment banks. Most of their profits were derived from corporate lending. They were a lot more like German banks, basically. Their structures were like that. So they tried to take on London and New York, but, industrial policy didn't over-allocate to that. That was actually happening.
No, indeed. And you're absolutely right. So the more serious point I was going to make is what you're describing in industrial policy for those Asian nations. My Western preconception is that it is conditional upon having a population that can be in some way repressed, or maybe that's the wrong word, but in a way that an Anglo-Saxon economy, populations of Europe or North America cannot be. Is that a distinguishing feature of the difference between what you're talking about then and perhaps what we're experiencing now in the US, for example?
Well, I would say that there was certainly financial repression going on in that period through capital controls and very underdeveloped banking services and things like that. There were not, mortgage products, for example, available for people to borrow and buy their house if they had to pre-fund, example. Syndicated loans hadn't developed yet in that period. Securitization, basic sort of financial market development was lacking, and that created a kind of repression. So I don't think it was the Chinese-style repression where they put a $50,000 cap on the amount of money you can send overseas. It was both cultural and unfamiliarity and just lack of evolution in the domestic financial markets that kept them in a backward state that they were in. Because industrial policy did not identify finance as a global sector that they could dominate. The only countries that made that choice were Tokyo, Singapore, and Hong Kong. Those three made an effort to become global financial centers, and they had the industrial policy backing to do it. All the other countries, it was focused on manufacturing and resources and transport and other areas. The contrast that I want to make on industrial policy is, before, during the positive phase of globalization, industrial policy was driven about how can we fit in? Which sectors can we potentially compete globally? Now, you use the term nationalism. I would say it's more national security driven. Industrial policy with your national security lens on is a slightly different animal than choosing sectors that you think you can compete globally on.
And it makes me think that perhaps this idea that globalization is deflationary and therefore economic nationalism or deglobalization must be inflationary. Of course, that may or may not be true, but your version of industrial policy, it's moot whether it is inflationary or deflationary. In the case of, EV pricing in the world on the back of China's decision to focus on the production of batteries and electric cars is clearly deflationary to the price of vehicles in countries that buy those vehicles from them, if that makes sense. I guess the question to ask you is the period we're in that is where we're moving back from, shall we say, peak globalization, is that necessarily inflationary?
I think it's mixed, actually, because globalization is still the background tendency. In every area that isn't restricted and isn't controlled for either national security reasons or geoeconomic strategic reasons that are being deployed at the moment, then I think the deflationary force is still there. You still have China, which builds manufacturing capacity at 5 times the potential domestic demand. So all of that capacity needs to be sold somewhere. It's primarily being targeted towards the global south and non-aligned world at the moment. So you'll be getting deflation down there. In the area of national security, we never had deflation anywhere. If you look at the supersonic jets and the nuclear weapons and the nuclear subs, those prices have only gone up. So in the pure military hardware space, it's going to continue to be inflation. What has changed is that now there's a whole host of inputs and sort of intermediate goods that we've identified that can become a problem in the event of war or pandemic, which is when most of us discovered these issues. And so there will not be deflation in that category of goods anymore because you've got this geopolitical risk friction preventing it from happening.
So, intermediate pharmaceuticals and
batteries,
rare earths.
Exactly. Rare earths, medical supplies, as we're seeing with pharmaceutical sector, components to drugs, things that people wouldn't have thought about before. They have the potential to be very deflationary because there's not a technological barrier to overproduction, but now there's going to be these export and import controls.
Let's go back to Japan, where we left off. You were there for certainly the formative part of your career, but for quite some time. You write a lot about what's going on in Japan. How did Japan get to where it is today? And is its path back to normality in a financial sense? Is it on that road back to normality? And is there a road back to normality that doesn't blow up the whole financial system?
So I lived in Japan from 85 to 95. So that I was there for the rise of the bubble and the bursting of the bubble. But then I was based in Singapore and Sydney, Australia for the next 10 years to cover all of Asia. So I was making, 6 trips to Tokyo a year. I was still very much plugged into the Japanese economy all through their so-called lost decade. I was a sort of first foreign BoJ watcher. I was very close to BoJ policy at that time. And so I was in constant contact with the Bank of Japan during the 90s when they were struggling through all of the trial and error to try to address this deflation that wouldn't go away. You can imagine what it was like in the 90s. No one else in the world was explaining.
No, exactly. No, so what was it like?
So, the policymakers were like, this made no sense. And of course, every foreign economist or policymaker would come and tell Japan what it should do, even though they weren't experiencing it and nobody had experienced anything like it before. I think that decade of trial and error, where they literally tried everything, rolling fiscal policy, supplementary budgets, cutting rates, QE, bailing out the banks, they did everything, brought them to the point where the rise of Abe was, forget symmetrical risks. We have only one risk. We live in an asymmetric risk world now in Japan. Just flood the market with liquidity, push fiscal policy lever and industrial policy lever and currency policy, all in the same direction. And let's save our nation.
Just explain the nature of the asymmetric risk that these policymakers. It's just the risk of debt deflation.
Yeah, the risk of deflation after a 15-year period of having exhausted all of your monetary and fiscal levers. That was the asymmetry, because rates were already at zero. You couldn't cut them any further. And fiscal policy was already an issue now. It had the highest debt to GDP in the world. So there was this asymmetric risk. We have to save ourselves. And that's what gave rise to the 3 arrows. So Abe, made a rather simple point where monetary and fiscal policy, industrial policy were not coordinated. We were using one at a time, and sometimes they were offsetting each other. So let's push all 3 levers at the same time. And that's essentially what they did. And they got the reflation, but there's no counterfactual. So you can't really say that Japan would have succeeded if nothing else was going on outside of it. And there were quite a few things going on outside of it. So the rest of the central banks in the developed world also adopt monetary extremism and flooded the world with liquidity. So risk assets began to go through the roof in all countries at that time. So you got asset inflation as a backdrop to Japan, and that helped the stock market to bottom. And actually, if you go back and look, the Nikkei does bottom back in 2012-13 and begins its upward rally along with all of the other developed world equity markets, long before Japan theoretically exited deflation. So a global risk asset rally based on excess liquidity helped Japan a lot to succeed in exiting deflation. But then now it's moved into different structural headwinds. It has the aging population and the shrinking labor force, and it has this enormous geopolitical heavyweight on its front doorstep in the form of China that doesn't offer very many reciprocal benefits to Japan's growth story. In the 90s, when Japan was first forced to offshore in the way that the West was forced to in the 80s, China was just rising. So a lot of Japanese factories moved to China. It just turned out to be a very difficult cultural relationship between Japan and China. And that, has not turned out to be a very effective offshoring strategy for Japan. And now with all sorts of political backlashes, it's not a very stable export destination either. So Japan has not benefited from the rise of China in the same way that Southeast Asia has, for example, or even Korea. It has all of these other baggage from the past, from World War II, that has prevented it from succeeding where the others have. Japan has had to navigate a more difficult global position. That is its starting point. And as a result, it has more effectively integrated with the West. It has a broader, more diversified export strategy. And it's actually in a better position for what now becomes a kind of a ruthless bifurcation of the global economy. I would say Japan is well positioned, but only because it's been through, a very long baptism of fire for 20 years,
But in many ways, it's an outlier geopolitically, because, if you think about the world, if modern Trumpism is a sort of reinvention of the Monroe Doctrine, and that involves maybe leaping forward here, but a grand bargain with China that given time, China can have Taiwan, we'll take the Americas. Japan is sort of an outlier in that sense, but it's also an outlier in monetary policy terms as far as its interrelationship with financial markets are concerned, because its policymakers are thinking about how it can move rates up without upsetting too many things and people, whereas the rest of the world are thinking about how they're going to move rates down.
If you think of the top 5 largest economies in the world and you look at their sphere of influence, Japan has one of the most difficult ones. It's not surrounded by a bunch of easy trading partners. Korea, difficult past and a ruthless competitor in almost every sector. China, difficult past and a predatorial competitor in every sector. And then Taiwan, maybe in the realm of fair competition, Taiwan and Japan have risen together. Then after that, it had previously viewed its domain as the APEC nations. APEC was the first and original framework for defining that market, which has completely lost its relevance. And then the Indo-Quad was conceived under Abe, but more as a future security arrangement rather than a market. So Japan has had to try to join ASEAN Plus type of arrangements, and it has had to do bilateral trade agreements with the US and with Europe. It's had to try to construct its economic sphere of influence because it doesn't have one naturally. So it is the preeminent diplomat. It's had a peace constitution. It doesn't have a big military industrial complex. It has made these gains in all the peaceful domains of the economy. So it has had to excel in probably the most difficult aspect of globalization. And to its credit, it's done very well.
And in terms of monetary policy?
Monetary policy, unfortunately, one of the areas of concern. A lot of these things have to do with Japan having had to go first in terms of having to clean up its banking sector and deal with deflation. But also the period of Prime Minister Abe's 3 arrows, where he placed his partner Kuroda in the Bank of Japan and pursued the extreme monetary policy, just actually lasted a bit too long. Kuroda did not really ever manage an exit. He had to retire and pass on to Ueda to begin to manage the exit, where, most of the Western central banks, the Fed, for example, began tapering in 2019. And most of the other central banks, after having flooded the market with liquidity with COVID, they also were looking to begin exit early. Japan didn't actually start the exit process until Kuroda left and Ueda came in 2023. And so they have such a long way to go, and they've only just started. And the market has decades of conditioning to not respond to interest rates either in a positive or negative way. We used to write consistently in the 90s that you have 40% of Japanese households are on fixed income And the interest income used to be a big component of household income. If they would only normalize interest rates, you would actually boost household income and increase construction. People don't even hold out that aspiration anymore. And you have the central bank saying, well, we're so cautious to raise rates because we really don't know how the economy would actually respond to having normalized rates of 1%. So that's a worry when your central banks don't think they know how the economy will respond to 1% nominal interest rates. So you can see there's a lot of rehabilitation to take place, and for this central bank reaction function to get back to some level of predictability so that we can, normalize monetary policy in Japan.
Should the rest of us still worry about the potential of the unwinding of the yen carry trade?
Absolutely. I think that the weak yen is such a big part of the Japanese recovery story and all of the investment thesis that currently back most of the capital that's flowed into Japan since COVID. I mean, even Warren Buffett's big trade that he has on in Japan, buying the trading houses, his average cost on the yen is somewhere between 110 and 120. And the trading houses, I think something like 70% of their revenue is offshore. So he's ridden that yen, tremendously, 30-40% depreciation of the yen. And he owns stocks that have their earnings that translate very favorably because it's all offshore.
He issued yen-denominated bonds as well.
And he knew that yen was going to weaken, so he financed it in yen as well.
It was the ultimate macro trade, wasn't it, really?
Yeah, it was a brilliant macro trade. And if you think about it, the trading houses are like buying ETFs on Japan's economy. I mean, they are little micro structures of Japan's overall economy. So if he did the right trade, I think the thing to watch with Buffett would be when he decides to pay down that debt. When he decides to say, okay, that's it, we're going to he's got the cash to do it. So just take that and pay off the debt.
Yeah.
That will be because he believes the yen has probably bottomed. And he might even begin to sell the trading houses because they're the component of the Nikkei that has the most exposure to overseas earnings. And if we go into a structural yen rise, then
sure they'll have that. Yeah,
it's very hard to attribute too much to what's happened in Japan when the currency has weakened 40 to 50%. Any type of policy settings during that environment, still would have produced a lot of gain for Japan because it's so sensitive to the currency. So when the currency finally turns, the opposite will be true. A lot of the macro trades in Japan will reverse, capital outflow will accelerate, and corporate earnings will be hit, and therefore they won't be able to invest and keep this virtuous circle that they have going now. The yen carry trade is kind of the key to all of those.
You said a couple of times that Japan are ahead of the rest of us in its monetary policy. What can we learn and do differently, say the UK or the US?
Yeah, I think on the issues of like aging society and shrinking workforce, I think there's some real concrete information to learn from Japan's experience. On monetary policy, because the Bank of England and Fed and ECB had such a long period of zero interest rate and QE as well, they're not too much different than the BoJ now on the exit strategies. The difference, I would say, would be on their inflation track records. They all normally confess to be inflation targeters, but they've got these poor track records of actually delivering inflation. Japan doesn't even attempt to bring inflation under control. They're still very much in this.
They're still in the mindset of trying to create it.
They have this kind of fade exercise still going on where they think 5 years of overshooting inflation is probably going to be necessary to offset all of the deflation, et cetera. So I don't think that's a lesson that's very applicable to the West. But I think the balance sheet use, they have all more or less seemed to come to the same conclusion. Reducing the balance sheet, in particular, getting all of the credit off of the balance sheet, is an equal goal, I think, on all the central banks. On the liquidity issues, Japan is so far away. There's nothing to be learned there. The Fed is the closest to getting to a level where a liquidity environment is actually going to start to fundamentally change some aspects of the interbank market. I personally think some of them would be for the better. I would like to see the Fed move back to a more scarce reserve management and eliminating a number of the spread trades and arbitrage trades and hedge fund activity in the interbank market. And whether that has a knock-on effect to the equity markets, I can't really say. I think that the equity markets are going to fall based on earnings failures, and the earnings failures in areas which are dependent on liquidity probably have already started to happen. The AI bubble, for example, is very divorced from the excess liquidity policies that are being provided by the central banks. So I think that the pointy end of the correction in equity market isn't connected to the central bank policy. But when the accident happens and it starts to unfold, it will create this dilemma again for the central banks. Are they going to respond in the same way that they have to the last two crises, where they're just going to go back to using the balance sheet and flooding liquidity, or not? And if they decide not to do that, then I think it means we finally have a proper correction in equity market.
Let's just go back to Asia and let's just have a quick look at China. We've talked about the relationship between China and Japan as the Chinese miracle of the last 25 years. So what are the similarities between China? I mean, you said that China had modeled itself, in part at least, on Japan in the 80s. So in a financial and geopolitical sense, what are the similarities between China today and Japan in the 80s and 90s?
So Japan had its big urbanization event from sort of 50s to 70s, and China has been pushing that same urbanization from, let's call it sort of 90s to the present. And when you have that big urbanization movement, you get a property bubble. And so Japan went through that, Korea went through that. All this North Asian sort of manufacturing workforce models, they had their urbanization movements as well that created property bubbles. And that's a phase that is probably not yet over. I think China probably has another 5 years or 10 years maximum to go before its urbanization trend is finished. But the state-owned misallocation of resources produced a slightly worse effect than the Japanese one, which maybe had some industrial policy influence. And it was often argued that the zaibatsu in Japan and chaebol structures in Korea emulate a state-owned model a little bit, but they don't, because they still have ultimate responsibility for all the assets on their balance sheet. So China has ended up with a worse set of overinvestment and inventory overhang and broader geographic footprint for the real estate problem than Japan had. And it will be working through this for the next 5 or 10 years. The difference is you have 4 major banks in China, and they're state-owned banks primarily, and the government can go in and clean up NPLs whenever it wants and recapitalize the banks in a very draconian way. And in Japan, it was private sector zaibatsu groupings that they had to break up and force mergers and force NPL realization, etc. So it was a slower, more difficult process that took the whole 90s before they could clear up the banking sector. So I say China has the worst version of the problem, but has the bigger levers in terms of state-owned company to clean it up. But, like I said, we're not there yet. If you think back to 1999, when Zhu Rongji was given that task of cleaning out all the NPLs off of the state-owned banks and purging all of the SOE zombies at that time, NPLs were 25% of the banking sector. And you saw that period in 2 or 3 years where he cleaned up the entire banking sector and purged about 60% of the SOEs. And then China, was ready for WTO entry and moved on. So when they get ready to deal with it, it can be quite dramatic. But you see, China did that in 1999 as a prerequisite to WTO entry. They had
I wasn't aware of that. So they're doing this second time round in some ways, and that was a cleaning up of their financial mess, their financial markets, their banks, as a precondition for joining the WTO, which was in 2001, I think.
What I meant by that was that was a positive external incentive to do that in a compressed way, to clear the decks so that they could show that they were modernizing a socialist economy and that they deserved to be allowed into the WTO, which was a free trading market. At the moment, there isn't that external incentive. They will micromanage it. They will hide it. They will bury it. They will not reveal to the world what they're doing. They will be doing everything on their own terms. And therefore, they could repeat a lot of the Japanese mistakes of fumbling along and not addressing this problem quickly. So that 1999 episode is universally viewed in very positive terms.
Yes.
Zhu Rongji was a miracle worker. No one thought it could be done. And he did the whole thing in basically 2 years.
But it's almost like in 1999, there was a market-like discipline imposed on them that is absent today.
That's right, because it was the Asian financial crisis. The Asian financial crisis revealed to China, the dark side of Western capitalism. They understood where the vulnerabilities were, and they saw banks across the region, Thailand and Malaysia and Korea, being forced to restructure. And so, it was in the air in that moment in the late 90s that you have to admit you've got a problem and you have to carve out your NPLs and recapitalize your banks and push for a fresh start. It was almost an IMF-sanctioned restructuring.
So does that mean that China is now going to have some form of lost decade? Maybe it's already happening and we don't know about it. I don't know.
I think so. I would say that you're already in the early years of that lost decade. I just don't think people can appreciate how little critical press is available in China. When we had the Asian financial crisis or when we had the crisis in Japan, all of the world mainstream financial press was there on the ground, just writing all the gory details for the world to read, etc. In China, you get no real information about what is going on. You get to read what you're allowed to read. I've seen stats where you have 600 million unsold units of condominiums or apartments in China. That's equal to 60% of your population, and you have a shrinking size of population. So there is a big problem in China already with zombie companies, unsold inventory in the housing, and youth unemployment, etc. And they have built up this massive manufacturing overcapacity that they can't now easily sell to the world as originally planned. So that's what the first part of the lost decade looks like. If they don't take a draconian approach like they empowered Zhu Rongji to do in the late 90s, they will tinker the way Japan did, and they will end up taking 10 years, and you will have your lost decade.
What are the investment implications for that? What theme do we address in terms of thinking about, or do we not even bother thinking about, investing in China?
Well, I'm actually not an investor in China, so I can't really offer much in terms of how to invest in China. I think that one of the things that the bifurcation of the global economy between sort of the US and China-centric spheres does is it makes Hong Kong much more important to mainland China than otherwise. I think between sort of 2005 and 2015, China probably very much had the plan to make Shanghai a global financial center, and they even potentially open the capital account. I think all those bets are now officially off. The capital account stays firmly closed. And we should talk a bit more about that, because that's the primary difference between China and Japan.
Okay. Yeah.
Is the closed capital account. But in any case, what it does, it makes Hong Kong much more important. Hong Kong is their open capital account, more laissez-faire in the whole mold of Deng Xiaoping, the open door economic policy for finance. And so whatever investment I would make in China, I would, have it based in Hong Kong. Hong Kong would be a lever that China uses as much as it can, and the world will mostly accept. Not having a free-floating exchange rate and not having an open capital account is actually the biggest obstacle to China's success. And, no economy in the world of even medium size has managed to succeed and be successful in the global economy continuously without an open capital account. So here's China, second largest economy in the world, trying to run its affairs with a closed capital account and a fixed exchange rate. Japan, during its bubble bursting phase, asset deflation, and then eventually the reflation period from 2005 onward, use the currency policy and the capital outflow strategy constantly in order to produce some easing in financial conditions. Such things as like GPIF, the largest pension fund in Japan, revised all of its benchmarks for international assets from, something around 20% all the way to 50, 60% over the course of about 10 years to facilitate a huge structural outflow of capital to help weaken the currency and get all of the peers that are compared to it to emulate that capital outflow. And that's how Japan has become, the largest net investment position holder in the world. China hasn't used this tool at all. It revised its international allocation for its pension funds and life insurance companies in 2007 to 20%. And then it's just stayed capped there ever since. So even today, they got this 20% cap. in order for China to avoid deflation, it needs to have a weaker currency. And in order to have a weaker currency, when you're running a structural trade surplus all the time, you need this capital outflow. But its history has always been that it was resource and labor rich and capital poor. So every policy that it has is aimed at attracting foreign capital and holding it. It has no policy aimed at allowing its own citizens to export capital and earn diversified return. So I really don't know whether China will ever take that dramatic step, but I do know that it won't succeed unless it does. It has to have an open capital account in order to recover from this deflationary episode that it's into.
What about what Trump referred to as the meeting of the G2 and what I sort of referred earlier to the potential for a grand bargain? What's your take on that and its potential significance?
Well, I think this is one aspect of Trump's presidency that the West should be very happy for, because Trump is sincere in the fact that he doesn't want to be a war president. He wants relative peace, at least enough stability so that everybody can do business. He's a business president, he's not a ideological or war president. And that is incredibly fortunate because Xi, and I think the build-up before Trump's arrival under President Xi and the sort of foreign policy hawks around him in the PLA were pushing for a confrontation. And had you ended up with a very hawkish, ideologically driven president at this point in time, the clash would have been much more aggressive. So I think, at least my interpretation of the way the events have unfolded this year, culminating in the summit in Busan between Xi and Trump, is that they both accepted that they don't want war. They've seen enough from the Ukraine-Russian conflict to understand what that would mean, and that they've got to get back to some sort of dente that allows them to continue to pursue economic benefits for their population. So no change in status as peer rivals or anything like that. Let's do business, not war. I think that is the message and the tone that came out of that summit with Xi. And by business, it means doing business with others, not necessarily with each other. But if you're not fighting a war, then it means you're freed up to make all sorts of business deals and laterally in every direction possible. And I think that's the kind of dente that the US and China have come to. And it hasn't been very well written, in my opinion. And I'm not a internal to China political specialist. I can't read the tea leaves like a lot of the specialists who I follow can. But I've been very surprised that people have not interpreted the purge that took place in the fourth plenum, where a number of generals and PLA leaders that were close to Xi were all purged in this last plenum. I'm surprised it hasn't been interpreted as a sign that they've dialed down the war footing, because it looks to me like that is what it was about. A lot of them were associated with a more hawkish stance against Taiwan. And I think that this ultimatum was building, like, we have to make a move for Taiwan now or we're going to lose the chance. This kind of narrative had been building last 5 years based on China's growth trajectory and US's decline trajectory, etc. And I think that it looked to me that purge was an acceptance by Xi that, okay, that window has closed, actually. Let's go back to some form of dente where we can all rebuild our capabilities and capacities, and maybe we'll deal with this 5 years, 10 years down the road. And if that's the case, it's very positive. I wouldn't call it G2. I'm not really sure why Trump used that term. I think it's about as positive of an outcome as the world could have hoped for, because it was a de-escalation to some sort of dente in which up till now had been a geoeconomic warfare.
Yes.
Not kinetic warfare. So dente and an economic war, I would suggest, looks something like this.
What are the key themes, asset classes, opportunities that interest you in global markets today?
This global bifurcation theme that I've been writing about, and I know you've had Marvin Barth on as a guest too. He has written a lot about in global entropy, etc. Is a thesis where the US and China form, relative trading blocks where the levels of trust are higher and therefore the conditions of trade can be more favorable. This reindustrialization, home bias, and military enhancement of self-reliance implies a number of sectors which are not going to be open for trade between the West and China and do not offer this big scalability story. I've been looking to invest in tech stories that are going to benefit from this bifurcation and benefit from this concentration on home bias and military industrial complex development. But I would say that I feel like those are probably peaked now. I mean, the valuations have run ahead so strongly. The theme still has years to run, but the valuations are run ahead so far. I'm not interested in chasing them anymore. So I've actually kind of reduced myself slowly into a very defensive portfolio for 2025, not expecting too much in terms of multiple expansion. And I just want to wait and see how earnings broaden out beyond the very few names that are participating in the AI bubble, as people like to call it. And I'm not sure what the second round and third round effects are. I want to watch that. I see constraints both in the energy space, how those constraints can be addressed, and also how do we address the employment side of automation and AI implementation. I think there's policy responses to those, but I just want to see that they're intelligently conceived and implemented. And then I think there can be some broader growth investment stories. But I'm in a very defensive posture at the moment, and I've sold most of my equity positions. And now, I'm much more inclined to own certain currencies, which I think will appreciate. And I think the commodities uptrend is just getting started and has a lot further to run. Unfortunately, I'm not super bullish on the equity market. I don't have a lot of high conviction trades to offer.
It seems like the dollar has driven a lot of other things this year, be my take. It looked like it was breaking its downtrend in recent days, but it's shied away from it and looks like it might be continuing its downtrend. Does your thesis imply further dollar weakness over the medium term?
No, actually quite the opposite. I actually think that the dollar correction in Q2 was, a shock response to Trump's Liberation Day announcements, which I think caught a lot of people off guard. And I think now as they've digested all the shocks, we're getting back to relative fundamentals. I never liked the sort of US exceptionalism type of thesis. Just simple relative value. US companies are performing very strongly. Their earnings are coming through, and the growth story will come through if there isn't any shocks like this government shutdown over the next 12 months. And so I think the dollar just continues to float higher on relative macroeconomic factors. I have the view at the moment that the Fed and even the Bank of England and a couple of other central banks around the world are making monetary policy mistakes that are going to cause a reversal of interest rate policies next year. So I think in that environment, another inflation episode like we had in 22-23 will also be a tailwind for the dollar. I think the dollar moving higher in this environment should result in a much more intelligent portfolio construction. I know you're very focused on the UK market. So the UK market has good defensive stocks in it with high dividends and offshore earnings. If we could get sterling to peak and resume its downtrend, it would actually be very positive for the stock market. So yes. I would be more inclined to buy Japanese stock markets, British stock market, and even German stock market on a strong dollar thesis.
Okay. Typically, when we've had periods recently of a strong dollar, it seems to have a negative liquidity effect for certainly emerging markets, and more than a few people might say that the UK has more similarities to emerging market these days than a developed market. So by implication, everybody else, that we all need dollars for our daily existence. And when the dollar is more expensive, it makes life more difficult everywhere, including the UK.
The FTSE has, I think, the highest percentage of offshore earnings.
Okay, yeah.
In Europe. Macro traders, they trade these type of factors continuously. Like everyone buys South African stock market as well when Rand is weakening because they have a high percentage of offshore earnings, and so does the UK. UK has, the tobacco companies, and the Rio Tintos and BHP. It's got the big diversified mining companies, and they all have large overseas earnings. So they trade like a short sterling proxy, and they can attract global capital flows. I think a stronger dollar world actually reflects this kind of bipolar economic rivalry we have emerging between China and the US, and it would actually be more beneficial in terms of financial conditions for all of the US's trading partners. So I think it would be a more positive world. Now, how the dollar gets there is dependent on how some of the events unfold in the US. Thankfully, it looks like the government shutdown is now over. That was a negative that was overhanging the US growth story that I was worried about. And like I said, I do think that the Fed is making a mistake on monetary policy. If the inflation does come roaring back in 2026, the reversal back to a tightening posture is not going to play favorably. The equity markets are going to sell off quite hard on that. A few things have to fall into place, but with the dollar resuming its uptrend and global growth getting a stimulus from that, then maybe the equity markets consolidate here for a year and then resume their uptrend. But I'm willing to sit on the sidelines for that, basically, is my approach. There's not enough clarity yet for me to position between now and the end of the year.
And of course, there's the issue of whether the Supreme Court is going to uphold the objections to the Trump tariffs, which looks like it could be an overhang to the whole US scene for a number of months. How do you see that unfolding?
The legal warfare in US politics has become very problematic because, I'm not a lawyer myself, and the US constitutional interpretations or legislative interpretations are so complex. It's really an area for the very, very highly specialized. But, I lived through that period in Japan in the early 90s when the US was pushing Super 301 on Japan every single year, trying to force markets open. So there's a lot of precedents in support of Super 301 and Section 232, et cetera, that the Trump administration can fall back on and begin to argue. The economic emergency one, I think, is a case you have to win. You have to articulate it very well, and you have to rein in some of the behaviors where Trump sort of impulsive fashion leveled a tariff on someone because they didn't like what they said or they did, et cetera. That type of behavior would stop. But I think you can articulate the emergency on fentanyl, and I think you can articulate the emergency on the size of the trade deficit. But then if the trade deficit were to correct, for example, to say 2% of GDP, would you have to take it off? I think that Super 301 and Section 232 are better fundamental basis for the administration to use anyway, because this gets at the heart of the invisible trade barriers of their trading partners that have always been the problem, including the subsidies which China through a state-owned economy applies, but also our favorable trading partners where it's standards and regulation that end up being the hurdles to trade. So I think Trump will run with a tariff strategy his entire 4-year term. And if the Republicans win in 2028, they will continue to run with it as well. So I think it is more like...
What you're saying, they're going to find a way.
They're going to find a way, and it should be done more intelligently. And it's fine for the Supreme Court to weigh in, and we distill it to something more intelligent.
It's the due process and the checks and balances that go with the territory. Mark, you've been very generous with your time. It's been fascinating. I could go on chatting to you for another couple of hours, but I know you've got other things to do. Thanks so much. I love reading your stuff on Substack, which is wide-ranging and very insightful. So thank you for that. And thank you for being able just to clarify to a generalist some of the subjects that you talk about in so much more detail. I found it very beneficial and very interesting.
You're welcome.
Brought to you by Progressive Equity.